Now you know good and well when you hear Rush Big Money on Yellowhammer Radio what time it is. That means it's Jeff Roberts time, baby. Now, I'm making a policy on this program. We only bring on the smartest. I mean, good God, I got Scott Beeson sitting across from me right now. I mean, you know this is true. All right?
High standards.
That's what Steve used to be. You remember old Steve when he was a producer of this program?
Oh, yeah.
Had to kick him to the curb. Had to bring you in here, Jeff. We could only have the smartest folks on the
Best
program.
of the best. You're much like Trump.
Very much. Only dealing with the best and the brightest. And when we're talking about wealth advisory practices, Jeff Roberts and Associates, I've already told you what the deal is. You already know what the deal is. And we're bringing on the man, the myth, the legend right now, Jeff Roberts. Jeff, how you doing today?
Fantastic, Cliff. Good to be on here with you guys today.
I can tell how thrilled you are.
Yeah, he sounds excited. He's like,
I'm still blown away at the music intro. I'm just telling you. I got Rush as a theme song.
It's perfect. It's perfect. Well, before we get started, let me tell folks a little bit about you. As an Ameriprise private wealth advisory practice, Jeff Roberts and Associates is comprised of knowledgeable financial professionals who can help simplify your complex wealth management needs and provide the superior level of experience, wisdom, and service that you deserve. They deliver personal, one-to-one attention to help you grow and preserve your wealth, transfer it to those you care about, or use it to more fully achieve your dreams. As leaders of the practice, Jeff Roberts and Associates are exceptional financial advisors who have provided sophisticated financial planning and advice to high net worth clients for years and years and years. I love these guys over at Jeff Roberts and Associates, and Jeff today is going to provide us a little more context. Now, last week we talked about the performance of the U.S. stock market during election years, and this week I want to talk about if there's any correlation between market performance during presidential election years and political party. So, Jeff, talk to us about this a little bit. Are there any trends here that we should be aware of?
Yes and no. And in order to understand it, there's some people out there that have done extensive research. Dr. Brian Jacobson, who, like last week, we were talking about the team from Wells Fargo. Brian Jacobson is their strategic portfolio strategist and chief portfolio strategist. He's done extensive research to try and figure out, are there any trends? And as an advisor, I'm in back-to-back client meetings every day. And perhaps the single most common question that I have heard in the last month or two when clients come in is they're asking about how will the presidential election impact markets. And you'll hear varying reports on the U.S. stock market performance during election years. But there's a couple things investors need to remember. First, the president itself doesn't really determine those market returns. Obviously, markets are long-term investment strategies, and although you can make tactical changes to a portfolio on short-term issues like an election, generally a long-term perspective is wise. And markets are very and highly complex. They have a lot of moving parts. So just a presidential election or a party specifically probably doesn't have as huge of an impact. But policies seem to matter more than the presidential party itself. Policies, that is. And so policies are more tied heavily to the composition of Congress, probably more so than presidency.
Okay. So that's actually that is pretty. I think that's surprising probably for a lot of people because the press sets the president up to be the be-all, end-all. That we elect a president of this party or that party, they're going to, with the wave of their magic wand, I suppose, fix or destroy things. But really, you're saying it, for the market perspective, it probably matters who is in control of Congress more than who is in control of the White House?
Generally speaking, I mean, obviously the legislative and executive branches have to perform in concert to some degree. But as we have seen, if Congress isn't supportive of policies, then we're not getting anywhere. Mm-hmm. And on the flip side, if they're working very closely together, then it's amazing what can happen. I mean, if we go back in history, I mean, let's just look at the history books. The last time we balanced our budget and paid down our debt, Bill Clinton was in office, but Newt Gingrich was running Congress. Mm-hmm. Remember, he got elected with a contract with America that said, elect me and we're going to do these things, one of which was balance the budget, pay down debt. Clinton ran on the same campaign. So it took a bipartisan approach at that time, i.e. policies. And once they got together, regardless of who's in office, it's whether or not they're going to work together and push policy that makes a difference.
So it sounds like it's pretty difficult to say whether the markets prefer Republicans or Democrats in control. Is that what I hear you saying?
It is. And so if we're looking at the challenging issues around that, bottom line is to prove that one party is superior to another by virtue of the stock market's performance, that's problematic at best. And there are two factors, or I should say a number probably of factors that are very challenging that you have to bake in order for the data to be relevant. For one, you have to figure out, well, do I include dividends in the performance of the market? Because a lot of people just look at the price performance of the market, where dividends can be a substantial part of that, particularly when the markets are flat like last year. You have an S&P that's basically 1% for the year, including dividends, and negative without it. So you have to decide, do I include dividends in my calculations? And then what about inflation? Because inflation in the 50s was extremely low, as well as it was in the first 10 years of this decade, but is very high in the 70s. So a 1% return is worth not as much in one period of time versus, say, today.
Mm-hmm.
So, and then if you think about taxes, my gosh, imagine putting taxes into the equation. What's the real after-tax return of the markets? And then the last component that makes it very challenging to figure out is, when is the starting point of when you determine when the market is going to be tied to one president or another administration? In other words, do you start at the election, the day of the election? Do you start the first day in office? Or do you just do it 12 months, from, say, November when everything kicks in?
Sure. So the data that we do have, and it sounds like it's kind of complex to read, and there's a lot of variables here, but whatever data that we do have, what do the numbers show?
Well, Dr. Jacobson's study, he did a great job, and he came up with kind of a formula that says, let's do a forward-looking projection, because markets are generally forward-looking vehicles. They anticipate things. So he said, well, let's start from the day of the election and go out 12 months. So from like November to November. And then he adjusted the numbers for inflation. And when he did so, he went from 1856 to 2014, so 158 years.
It's a decent sample size.
You would think it's a pretty good size. So if you look at the starting with the election, the rate of return of the S&P 500 when a Democratic president has been in office, the return has been 9.22% on average. The Republicans' rate of return is 8.11. And so when you hear that, of course, my Democratic friends are saying, man, the Democrats have better performance, and then Republicans might say, we're not as good. Well, what's interesting is if you just twist the data and take the same data but look from a different point, do from inauguration and go 1 year from that date, then it flips. Republicans are in the lead with an 8.59% rate of return, and Democrats are second place with 8.33. The bottom line is they're both around 8 to 9%, regardless of what time frame. So there's not much of a deviation between those two numbers, whether it's Republican or Democrat.
So do we have the data that breaks out the stock market's performance under different administrations or under various compositions of Congress? Anything interesting there jump out?
There is, and this one's pretty interesting too. If you look at administrations, the presidency being one political party and Congress being the same or different, we've got data broken out completely. The best performing scenario in history out of 100, in this case, 57 years, the best performing was when it was a Democratic president but a split Congress. And that was 11.26% return on the market on average. Every time that's happened, you pull all those together in an average amount. The problem with that one is there's only been 12 times out of 157 years where that's occurred. So the sampling size is fairly small. It's only 7.5%. I know this is incredibly boring data, but the second place scenario is if there's a Republican president and a Republican Congress across the board. Then there's that second place performance, which was 10.75% return on average. And the worst performing is, interesting, a Republican with a split Congress. That's only 20 occurrences, though, and that was 2.25%.
Yeah.
And it's interesting. We have right now, of course, we have a Democratic president and then a split Congress, which is that's the number one scenario that we're seeing right now. And chances are the Congress is going to be split again. I mean, who knows? I'm no expert on that. So it'll probably be one of those scenarios. If we look in the historic pattern, either 11.25 or 2.25.
All right. So it sounds like what I'm hearing you say is the markets don't really much care if they got a D or an R beside their name. It's really coming down to what policies are being advanced at a specific point in history. And so I guess my question for you would be, what are the policies that the markets like? I know last week you talked about the markets like stability. They like to have certainty about things. They don't like uncertainty. Outside of that, what are the specific policies maybe that the markets like?
I'd have to do some more homework to get a historic trend on that, but I would generally say pro-business, pro-growth is clearly what markets are going to like the most. Markets like predictability and they like clean balance sheets. So, for example, when we saw back when I described a minute ago Clinton in office and Newt Gingrich in office, and they're balancing the budget and paying down debt, and we had a technology boom and markets were cycling tremendously well. Good financial balance sheets coming out of Washington is a smart thing. We really haven't had that in a while, so it's not surprising that our markets have been choppy. So pro-business, pro-growth, and clean financial statements are probably the best overall trend for economic growth of the U.S. equity market.
All right, so let's get a summary here for us, Jeff. What should our listeners take away from everything they just learned?
The S&P index returns during Democrat and Republican administrations is of no value to investment-making decisions. In our opinion, there's nothing about that tells you buy, sell. There is no clear forecast for investors to use when really benchmarking history. There's interesting data. It's fun to look at, but I don't think it causes anybody to need to adjust their portfolio. And actually, Dr. Brian Jacobson said it best in his article. He says, when it comes to the markets, elections matter, but relationships between who wins and whether the investor wins really isn't neatly summarized by election results. It says vote, but don't let your politics taint your portfolio.
Gotcha. Jeff,
I think it's sound advice.
I think it only takes one segment of folks hearing you on here to know that you guys are really on top of this stuff. If folks that are listening would like to have you and your folks helping them with their investments, their portfolio, their wealth advisory in general, how can they get in touch with you guys? JeffRobertsandAssociates.com, or you can just certainly give us a buzz at 313-9150. Perfect. Jeff, thanks for taking the time to talk to us today. Good to be with you. All right, let's take a quick break. Give the folks over at Jeff Roberts and Associates a shout. JeffRobertsandAssociates.com. Back in just a minute.
This is Yellowhammer Radio.